Joining us now to discuss, Jim Bianco of Bianco Research, Mike Contopoulos of RB Advisors. Jim, looking at this move this morning, yields down something like 10 basis points right the way through the curve. Two's out to the 10-year yield down 10 basis points to about 470. Jim, in your mind, is that risk aversion or Fed speak?
Oh, I think it's probably more Fed speak at this point. If you go back 24 hours ago, the bond market had reacted to the weekend events, and I'm talking about futures trading in, German bunds at this point, and it was largely unchanged. Then we got a bunch of Fed speak yesterday about higher for longer and no more rate hikes, and then you had the big move throughout yesterday. So it seems like it's more about Lori Logan, who's the Dallas Fed president, Richard Jefferson, who spoke yesterday, than it is about what happened in the Middle East over the weekend.
Jefferson, Logan, Daly, all over the last week. Mike, it's kind of amusing, isn't it? They're happy for the market to do the work for them, then the market stops doing the work for them. What's that going to mean for their next meeting?
Yeah, I was going to say the exact same thing, Jonathan. I mean, another couple days of lower yields and all of a sudden hikes are going to be back on the table. I just don't see, given the labor market dynamics that are clearly, maybe not, white hot, but red hot, some of the bottoming and the PMI data, et cetera, that, the Fed is not going to get another hike in at some point. And, instead of saying, asking the question, are they going to pause in November? Are they going to hike again this year? Maybe the market needs to start asking how many times are they going to hike in 2024? You're just not seeing the slowing that, many market participants thought that you would see. Inflation's not anywhere close to 2%. And it doesn't seem like things are breaking yet, just as when earnings are starting to accelerate. And so, surely at some point, there will be a point in time where the Fed is done and cutting interest rates and probably have a hard landing. But I just don't see that in the next 6 months or so.
It's the 3-month rolling recession call, Jim Bianco, and it keeps rolling. It keeps getting pushed out. This is from Morgan Stanley. Seth Carpenter and the team over there holding on to this baseline view that the last hike from this Federal Reserve was July, and ultimately they're relying on the noticeable slowing in the fourth quarter to stay the Fed's hand. Jim, you're taking the other side of that, aren't you?
Yes, I am. The whole idea that the recession is 1 to 2 quarters away is now going on 18 months. And I guess if you say it long enough, eventually those 1 to 2 quarters away will eventually materialize. But right now, it hasn't been. And if you look at the payroll number from last week and some of the recent data, and even the upbeat outlooks that we've had going into this earnings season, and I know it's early, it's hard to make the case that we're seeing some kind of a real recessionary slowing in the economy. Yes, there are sectors of the economy like housing that are struggling, but there's always sectors of the economy that are struggling. So the idea that, don't worry, we're going to see a slowing of the economy to justify the Fed being done and rate cuts next year has been wrong for 18 months. And I just don't see evidence right now that the tide is turned and that that's going to be the right call.
So, Mike, are you actually considering rate hikes from this Fed next year?
Oh, absolutely. I think you have to consider it. I don't know why you wouldn't, Jonathan. I mean, earnings growth, to Jim's point, is starting to reaccelerate. I mean, the earnings cycle bottomed several quarters ago, and growth is just still too hot. I think they're going to pause at some point for a quarter or a couple meetings. But my guess is their hand's going to be forced and that they're going to have to hike again at least a couple more times. I mean, financial conditions aren't that tight at this particular juncture. I mean, this is really a big conundrum for the Fed because the stronger growth is today, the harder the landing later. The problem is just, to Jim's point, when is later? Is it 6 months from now? Is it a year from now? We don't know. And I think between now and whenever that landing is, the Fed's going to probably have to hike again.
Mike McKee, Daly, Jefferson, Logan, all suggesting this market is doing the work for them. It's not anymore, Mike, is it?
Well, we're one day into that not anymore, but let's take a look at what we've seen so far. The 10-year note yield, along with the belly of the curve, rising a lot, and that's been pushing up real rates. You can see the 10-year, the white there, the real rate in the blue, and that's what the Fed officials are talking about. And as you mentioned, we've heard from a number of them over the last couple of days, including one that got a lot of attention, and that was Lori Logan, because she's been a real hawk. She noting if if the term premiums rise, they could do some of the work of cooling the economy for us, leaving less need for additional monetary policy tightening. That followed very similar remarks from Mary Daly, the San Francisco Fed Bank president, a few days ago, noting that financial conditions have tightened a lot, and that might mean they don't have to take further action. We'll see on Thursday what we get out of CPI, and we'll see if these bond market moves continue. You can see here the difference. The bond market was closed yesterday, and I said we needed to watch what would happen today. Whether you call it a flight to safety or whether you call it Fed speak driven, you can see that yields have come down on the 10, and that has pushed up just a little bit the odds of a Fed hike in November, but we're only at 16%, down from Monday morning at about 30%. So at this point, the bond market writing off the Fed. But as we have seen so many times, we can reverse that very easily.
Mike McKee, thank you, sir, for the update. Tomorrow, of course, Fed minutes, PPI data. Onto Thursday, you'll get CPI data. Looking at the bond market screen this morning, big rally, yield to lower. Two reasons for it out there at the moment. The Fed speak, some doves, Logan, Jefferson, Daly as well. Mike McKee spoke to that. Also, that risk aversion flow. Didn't get it yesterday. Treasury market was closed. Getting it a bit this morning. Jim Bianco, I remember you saying weeks ago that oil would take center stage. Has it taken center stage?
Oh, I think it has. I mean, we've already got about a 25% rally since late June. And now with the tensions in the Middle East and the big 4% rally yesterday, we're all going to be focused on oil. Has it taken center stage to bother markets? Not yet, but if this uptrend continues and reinserts itself, I do think it will become front and center. And it is probably the market metric that we'll be watching to see what kind of a market or financial impact we can expect from Middle East tensions.
So, Jim, with that in mind, if higher oil prices is the price to pay here in the market off the back of this, is that a reason for bonds to rally on risk aversion, which leads to higher prices, or a reason for the bond market to sell off on inflation risk? Which one is it?
Yeah, that's the old conundrum with oil. Is it a tax on the consumer or is it inflation? I think in this environment, it's more inflation. Now, I don't expect the Fed to raise rates because oil goes up. But the default argument is if oil were to go up and take gasoline prices with it, it further pushes any idea of a rate cut well into the future. That you just can't do it if you're seeing national price of gasoline go through $4. That is cutting rates. So don't expect them to raise them. Just you can forget about rate cuts.
Mike, do you share that conclusion?
Yeah, I think that's right. I mean, if you changed monetary policy, based on oil prices, you'd be changing, from tightening to loosening every other month. And so I agree with Jim. It's not going to change necessarily the Fed's calculus. It probably, for a period of time, has a bigger impact on inflation. But listen, there's certainly a level to which, gas and oil goes to where it really does start to hurt growth. I'm not sure if that's north of 100 or 110, whether or not the economy can handle 85 or 90 is probably the case. But, certainly level does matter into where it sort of begins to go from inflationary pressures that are the concern to growth concerns. But we're certainly not there yet. And so I think, it's more of an inflationary impact and but not going to affect the Fed very much.
Mike, give me your bond market call now. Considering rate hikes in 2024, what are you considering on a 10-year yield?
It's interesting, Jonathan. I have a little bit of a different view, I think, than a lot of folks out there. In my mind, the more the Fed hikes, the safer it is to be in something like the 10-year. I know that sounds counterintuitive, but think about what's happened over the last several months. The Fed's ratcheted down hikes from 75 to 50 to 25, has also ratcheted down the pace of hikes to every other meeting or so. At the same time as growth and inflation are stubbornly elevated, if not reaccelerating. So the market is telling you that the Fed is losing credibility, and I think that's why you've seen this bear steepening. The long end of the yield curve, of course, represents growth and inflation expectations. So there's an irony. If the Fed actually can get back into control in the market narrative by indicating some more hawkishness, you may actually see stabilization in the long end of the yield curve as the market starts to price, a come down of growth and inflation and ultimate hard landing. That's, of course, what's been priced out. So I think that at current levels, you want to be pretty fairly balanced in your interest rate risk. Take maybe some cyclical duration out there from counter-cyclical duration. and avoid credit risk, as I've been saying for some time.
Big rally this morning. Mike, thank you for your view. Mike Contopoulos there, Jim Bianco. Big rally in the bond market. Looking at the equity market this morning on the S&P.